Hello, everybody. This is Alan Ellman, the blue collar investor, and I'm pleased to present this educational webinar titled Covered Call Writing Dividend Stocks Plus Creating an Ultra Low Risk Put Selling Portfolio while still generating significant annualized returns. And for the put aspect of the webinar, we're going to be using Delta and weekly put options to achieve a 90% plus success rate. Now, the ideology of this particular webinar started in March of 2020 when the world was hit with the COVID-19 crisis. That created a lot of concerns regarding the stock market, regarding the economy. The Fed moved interest rates down to near zero and projected that those near zero interest rates would remain through the end of 2023 and possibly beyond. That created a lot of opportunities in the stock market. And as I always say, there's a lot of ways to make money in the stock market. And my way isn't the only way, but what I'm going to be doing in this webinar is presenting two ways to make money in this environment where we are concerned about the economy. We still want to generate cash, and we're going to do it in a very low risk way. So the two strategies we're going to present in this presentation, one involves covered call writing with a potential for 3 income streams. And the other is a very low risk put selling strategy where we incorporate weekly put options along with Delta. Let's get started. We're going to start in the first half of this webinar with the covered call aspect. And here's the strategy analysis. We're going to purchase only top performing blue chip stocks with this particular strategy. So that means we're going to focus to make things relatively practical and easy for us on the Dow 30 stocks. That's going to allow us to reevaluate our bullish assumptions every month. So with the covered call aspect, we're going to be going with monthly expirations. Later on, with the put aspect, we're going to be turning to weekly expirations. Now, most of the Dow 30 stocks do have dividends that are generated quarterly. Those are the ones we're going to focus in on. And so we're also going to be capturing dividends with the stocks that we're going to be using. So that would be cash stream number one, corporate dividends. Now, when we buy the stock and then write the covered call, we're going to be generating premium. So when we sell a covered call, we're agreeing to sell our shares for a particular price that we decide upon, called the strike price, by a particular date that we decide upon. We're using monthly options in this particular strategy. Now, we're also going to focus in on out of the money calls, which means we're agreeing to sell our shares for a higher price than they're currently trading for. So that represents another potential income stream. We have the premium from the option, and we have potential share appreciation from current market value up to the strike price. So I highlighted in yellow on this slide the 3 potential income streams: corporate dividends, call premium, and share appreciation. Let's start off by defining covered call writing. Now, there are 3 words in that term. Let's break them down. Covered means that we buy the stock first. That means we know our cost basis. If we simply sold a call option without first owning the stock, that would be naked option trading, very risky. Here we buy the stock first, and we're agreeing to sell our shares at the strike price, a price that we determine. Since we know the cost basis, that makes this a low risk strategy by first owning the stock, as opposed to a high risk strategy if we did it. Now, call is the type of option we are selling. So we are selling to some unknown person the right but not the obligation to buy our shares from us at a price that we determine by a date that we determine. And finally, writing means that we are initiating a sell to open trade. If we go to our broker platform to initiate that option sale, Well, that it will ask us what to do. We first click on option. What action do you want to take? We want to sell the option to open or initiate the trade. There might be an abbreviation for sell to open, simply STO. Let's talk about dividends for a minute. Most stocks that do have dividends generate them on a quarterly basis. Not all, but most. And in order to capture that dividend, we must first own the shares prior to the ex-dividend date. Now, the ex-dividend date always comes before the distribution date, or almost always comes before the distribution date. So if we own the shares on the ex-dividend date, then we are entitled to receive that dividend no matter what we do with those shares after the ex-dividend date. So how do we find out when a stock's ex-dividend date is? Well, one very reliable free website that we use for information that we put into our premium reports is dividendinvestor.com. So let me show you what that page looks like. And here you could see we're looking at Microsoft, which was trading at 180.53 at the time that I created this screenshot. Now it tells you that the annualized trailing 12-month dividend yield was 1.13%. It was projected to be higher moving forward. But 1.13% is what it's been generating over the last 12 months. Now on the right side of the page, it will give you the ex-dividend date, in this case, May 20th. And you could see that the actual pay date is after the ex-dividend date, in this case, June 11th. So all that information is available when you go to dividendinvestor.com, put in the ticker symbol, in this case, MSFT, and this information is available for free at our fingertips. Now, the blue chip report that we send to our members every month prior to the beginning of a new monthly contract evaluates the Dow 30 stocks. Now, over the years, we've been evaluating these stocks from two particular perspectives. The red arrow shows a 3-month price performance and then a 1 year by the blue arrow. But we recently changed that. I feel it enhanced the report to 3 month and 1 month. So we would like to see these shares beating the S&P 500 in both of those time frames, both the short and the longer time frames. And you could see that in this particular case, all 5 of these securities did beat the S&P 500 in both time frames. Now, at the time I made this screenshot, we were using 3 month and 1 year time frames. We recently changed that to 3 month and 1 month. But in either case, shorter and longer term. So the 5 securities that were eligible for this particular report were Apple, Home Depot, Intel, Microsoft, and Nike. And those are the ones we're going to be using as we move forward with this webinar presentation. All right, we know what stocks, what options are we going to select? Well, I told you earlier, we're going to be looking at 1 month options. So 1 month expirations. And if there is an ex-dividend date or an earnings date, we could circumvent those by switching over to weekly options. Almost all of the Dow 30 stocks do have weeklies associated with them. There may be, I know Travelers is an exception, there may be one other, but most of them do have weekly options. So let's say an ex-dividend date is the 3rd week of a 4-week contract. We could sell options on weeks 1, 2, and 4 and just skip over week 3. Now we're going to be using out of the money strikes because remember, this is a 3 income strategy. And in order to have 3 income streams, one of them must be share appreciation. You know, we have the capturing of the corporate dividend, we have the option premium. So we have to sell out of the money strikes to leave maneuverability to capture premium from, to capture appreciation from the stock price moving up from current market value up to the out of the money strike. We also must define what our goal is. So if we don't know what we're looking to generate, how do we know what strike price to select? In this particular case, we're going to look to get a initial time value return goal range somewhere between 1% and 3%. And you will see as we move forward, this is a very reasonable expectation, even for blue chip stocks taken from the Dow 30. Now, folks, if we were writing covered calls on an existing buy and hold portfolio where we do not want our shares sold, where that was very critical to us, we would set lower goals. That's referred to as portfolio overwriting in my books and online courses. And there we would lower our expectation to perhaps 0.5% a month, where the strike price is much, much higher and less likely to be exercised. But for the purpose of this webinar, our target range initially, when we're structuring our trade, is 1 to 3% for a 1-month return. So let's have a look now at an option chain. This is taken from the site cboe.com. And at the time, Microsoft was trading at 201.80. And if we're going to go out of the money, that means the strike price needs to be higher than that current market value. So we're going to look at the 202.50 and the 205 strike. Now, we always turn to the bid column when we're looking for premium. We sell at the bid, we would buy at the ask. And the bid column shows the returns of $610 per contract for the 202.50 strike and $485 per contract for the 205 strike. So that's the information gleaned from the option chain. And so we do feed that into the multiple tab of the Ellman Calculator or the Elite or Elite Plus calculators. And you could see in the blue cells on the right side of the spreadsheet, all the information gleaned from the option chain is entered into the blue cells. These are 1-month expirations. And then the white cells become populated. Let's have a look at the right side of the spreadsheet now. The return on our option or RU is 3% for the 202.50 strike and 2.4% for the 205 strike. So that does meet our criteria for 1 to 3%. Now, because we are selling out of the money strikes higher than current market value, there's also an opportunity for upside growth or upside potential. And that's highlighted in the brown cells you see on the right side of the spreadsheet. So for the 202.50 strike, there's an opportunity for an additional 0.3%, meaning there's an opportunity for 3.3% 1-month return on this particular trade. For the deeper out of the money 205 strike, there's an opportunity for 1.6% of upside potential if Microsoft moves from 201.80 up to that 205 strike. That means there's a potential of a 4% return on this covered call trade if we use the 205 strike. So both of the strikes do meet our 1 to 3% initial time value return goal range. And then the more bullish we are, the deeper out of the money we would go. Now let's populate for the 5 securities that you saw in the initial screenshot. And you could see that we have Microsoft, Apple, Home Depot, Intel, and Nike listed on the right side of the spreadsheet. We put in the price of the stock at the time that the calculations were made, and the option premiums for the out-of-the-money strikes and the out-of-the-money strikes listed, they all expired on the same date, July 17th. Okay, now, once we fill in the blue cells in the Ellman calculator, the white cells become populated. The initial return on our option or RU does meet our 1 to 3% initial time value return goal range. We're good there. And the upside potential also adds to that position. That is our next income stream, upside potential. So we have corporate dividends, we have return on our option, and we have upside potential. 3 income stream potential per trade. Okay, we have 5 securities. In this hypothetical, folks, we're going to assume that we have available $200,000 in cash. Now, obviously, many of us don't have that amount. They have much less. Many of us have a lot more. And so this can be tweaked to whatever your particular situation is. One size does not fit all, but the concepts, the rules and the guidelines are precisely the same, whether the portfolio is smaller or larger. In this case, we're going to go with 200K. So for 5 stocks, that comes to 40,000 per position. Now, it's never, ever, ever going to work out precisely 40,000, but we have to have some kind of structuring to our strategy. So we're going to say 40,000 per position. We divide the price per share into 40,000 and round to the nearest 100. That's how we calculate initially. So for example, with the price of Apple, we would purchase 100 shares at $36,617. And we do the same for the other 4 stocks moving down. And when we do our initial calculations, it came to us spending 198,204. Well, since we're starting with 200, we're good. That leaves us 1796 plus the premiums from the sale of the options for exit strategies. Now, what happened, for example, if we did these calculations the way I suggested in the second bullet, divide the price per share into 40 and round off to the nearest 100? What if it came to 205? Well, we don't have 205. What do we do? Well, then we would have to make an adjustment. And that adjustment would be to sell 100 shares less of one of these securities. So sometimes we don't come to this decision on the first time around. We may need to do an adjustment. In this particular case, we did. It came out nicely. So that's how we're going to enter our trades, as you see here on this screenshot. Now let's take a look at the 4-week initial time value premium returns based on the number of shares that we purchased, the number of contracts we're selling, and the premium for the out of the money strikes. And you can see in this screenshot here that Apple generated $8.30, so $830 for the 100 shares or one contract. And then so on down the line over here for all of the 5 securities. And it turned out that we generated a total initial time value profit of $4,680. Now remember, we spent $198,204 to purchase those securities. What does that come to? 2.4%. What was our target initial time value return goal range? 1 to 3%. So we are good. Let's summarize now the maximum covered call returns for this 3 income potential approach using covered call writing. The average initial time value return was 2.4%, which comes to 28.8% annualized. The average upside potential is 1.7% for these 5 securities, which comes to an annualized return of 20.4%. The average annualized dividend yield for these 5 Dow 30 stocks was 2.4%. So in an ideal world, which we never have, a maximum return, which we never have, would be about 50% for a year. Now that is our starting point. Now, obviously, we're not going to maximize every single trade in our portfolio every month of the year. But here's the thing that we need to know and understand, and folks, it is not rocket science. When we sell covered calls, we are lowering our cost basis. When we lower our cost basis, we are increasing the chances of us beating the market on a consistent basis. I've been selling options now for more than 2 decades, and there never has been a year that I haven't beaten the market. And when I say the market, I'm referencing the S&P 500. And many of those years, I beat the market significantly. And that's because we are lowering our cost basis and we are mastering the 3 required skills for option selling, which are stock selection, option selection, and position management. Okay, let's now turn to the second strategy that I'm highlighting in this webinar, and this is selling puts. Now, let me just tell you that this is a strategy that I developed in April of 2020 in response to the crisis created by COVID-19. Um, the market was unsteady. It crashed actually in March. The economy cratered. There was a lot of unknown. And I decided that I wanted to continue generating cash flow, but I wanted to do it in an ultra low risk fashion. So I thought a little bit outside the box, and this is the strategy that I came up with. And before we get into basics of puts, I just want to tell you that we're not going to be dealing with stock XYZ here. We're going to be dealing with real life examples and screenshots taken directly from one of my personal portfolios. You'll see how I actually managed one of these trades. Let's start off with the definition of what is an option. And it basically is a made-up thing. It's a contract that gives the buyer of that option the right but not the obligation to buy or sell 100 shares of stock at a fixed price known as the strike price by a specific date known as the expiration date. So in essence, it's the right to execute a future stock transaction. Now, we are on the sell side of options. It's the option buyer that has the control. We have the contract obligation, and that's why we get paid. Now, a call option, which we discussed in the first half of this webinar, gives the buyer of that option the right but not the obligation to buy 100 shares of stock at the strike price by the expiration date. So when we sell the call option, we are allowing some unknown person to buy our shares at the strike price. Now, if we used call options and put options in one multi-tiered option selling strategy, that's referenced in the BCI methodology as the PCP, or put call put strategy, and that's in my books and online video courses. Outside the BCI community, many refer to that as the wheel strategy. Now, a put option, which is what we're going to be focusing in on for the rest of this webinar, gives the buyer of that option the right but not the obligation to sell 100 shares of stock at a fixed price by a specified date. So when we sell a put option or a cash secured put, we are agreeing to buy shares at the strike price by the expiration date. We're only going to be using deep out of the money puts. So we're going to be agreeing to buy these shares at a much lower price than it's trading for at the time that we did this put sale. Okay, here's a preview example of how selling a cash secured put works, and then we'll get into specific real life examples of this ultra low risk put selling strategy where we incorporate weekly puts and delta. Let's assume stock BCI is trading at 75. We then sell the 72.50 out of the money put for $2. That's a reasonable return for a 1 month expiration. Now, the broker is going to require us to put a certain amount of cash into the account because we're agreeing to buy 100 shares at $72.50 per contract. That's $7,250. So we have to put that cash into the account to secure the put. But the broker is going to cut us a little slack, folks, and allow us to put that put premium towards the $72.50. So we only have to put in $7,050. That's our investment. $7,050. We sell the put option for $200 per contract, and now we're undertaking the contract obligation to buy 100 shares per contract at $72.50. Now, this premium is ours to keep no matter what, just like writing a covered call. The premium is ours to keep no matter what. But we do have a contract obligation to buy the shares at $72.50, which is decided upon by the put buyer, not by us. So they have the right to exercise that put at any time during the contract. But if that put is not exercised, that means we generated $200 of cash for an investment of $7,050, and that represents a 2.8% 1 month return, less very tiny trading commissions, and that annualizes out to 34%. Now, there are two possible major outcomes. Let's say the price of BCI remains above the $72.50 strike. Well, will the put buyer elect to exercise the option and sell their shares to us at 72.50 if BCI is trading higher than that? Of course not. So what will happen here is the option expires worthless. We have generated a 1-month return of 2.8%, 34% annualized. The cash is now freed up for us to secure another put for the next contract month. Now I'm talking traditional put selling where I prefer monthly puts, but we're going to be getting into this ultra low risk strategy where we're going to do weekly puts. The second possible major outcome is BCI does in fact drop below the 72.50 strike, and we take no action because we can always buy back that put if we don't want those shares put to us, as long as we do it by 4 p.m. Eastern time on expiration Friday. Let's assume we don't. Let's say the price of the stock drops below 72.50, we take no action, and the shares are then put to us at 72.50. What is our cost basis at that time if that happens? Well, the cost basis is 70.50 because we received a $2 premium. So it's 72.50 minus 2, 70.50 is our cost basis. At this point in time, we are no longer option sellers, are we? We are share owners. What do? Well, we could sell the stock. If we sell the stock and the price is higher than 70.50, we have a capital gain. If it's lower than 70.50, we have a capital loss. We could hold the stock for the long term. When we sell a cash secured put, we only do it on stocks that we would otherwise not mind owning in our portfolio. So we could say, hey, I love this stock. I'll keep it, tuck it away. And we could just keep the stock. A lot of put sellers use this strategy instead of setting limit orders, right? Let's say BCI was trading at 75. We like it, but we want to buy it at a discount. So we tell our broker, we set a limit order. Folks, tell our broker, here's $7,100. Buy 100 shares if it hits 71. Well, what if it doesn't? We don't get the shares at our target price. That $7,100 is sitting in our cash account, twiddling its thumbs, doing absolutely nothing for us. Or we could sell the 72.50 cash secured put for $2, and one of two things is going to happen. Either we get the stock at our target price, in this case a little less, 70.50, or we get paid 2.8% for the month not to buy the stock. The only caveat is we have to buy them in 100 share increments. So this is a great strategy also in lieu of using limit orders. Finally, we could write a covered call if we take possession of those stocks and use that PCP strategy where each month we're either generating cash flow or buying a stock at a discount. So when we sell cash secured puts, we're selling put options, which is secured because we have to deposit the cash into the brokerage account using the formula put strike minus put premium times 100 times the number of contracts. And that cash is available in case those shares are in fact put to us. So we are getting paid to undertake a contract obligation, just as we are with covered call writing, where we have an obligation to sell our shares at the strike price. Here we have an obligation to buy the shares at the strike price by the expiration date. Okay, now buckle your seatbelts, folks. We're going to start talking now about this ultra conservative approach to put selling that I created in April of 2020 as a direct result of the COVID-19 crisis. We're going to select elite performing securities. And those of you familiar with the BCI methodology know that we do this from a fundamental analysis perspective, sales and earnings growth, technical analysis, trend and momentum on a price chart, and common sense principles like minimum trading volume, like avoiding earnings reports, like diversification, asset allocation. All that is in my material. We're going to only sell deep out of the money weekly puts. I like weeklies in this case because we can reevaluate our bullish assumptions on these securities every single week. Given that the market could be so volatile because there's so much unknown related to this crisis, so many jobs have been lost at the particular time that I'm creating this video, and I created this strategy. So there's a reason for that. And we're going to use deltas of 10 or less. Now, delta as it relates to puts, since it's inversely related to stock price, is listed as a minus sign. So deltas of minus 0.10 or lower, deltas of 10 or less. We'll just call it deltas of 10 or less moving forward. Our target annualized returns is going to be lower than traditional option selling. In this case, we're going to target between 10% and 20%. Now, folks, with interest rates near zero, that looks pretty darn good for most investors. Okay, now I mentioned delta, so let me define it. And just to be thorough, I'm going to define delta from 3 different perspectives, but I want you to focus in on the third one as it relates to this particular strategy. So the 3 ways you can define delta. Number 1, it's the amount that an option price will change for every $1 change in share price. So if an option has a delta of 0.5 or 50, and the stock changes by $1, we would expect the option price to change by 50 cents. So that's a pretty popular definition for delta as it relates to our option positions. Another one is the equivalent number of shares represented by an option position. This is something that portfolio managers who manage very, very large multi-million-dollar portfolios look at, because they want to get a limit market risk. So for example, a call option that has a delta of 60 is the equivalent of 60 shares. A put option with a delta of minus 60 is the equivalent of being short 60 shares. And what a lot of these managers do is they add up all the pluses and minuses and try to come as close to zero as they can. That's called the delta neutral portfolio, and therefore minimize market risk. Now, the way we're going to define delta for this particular strategy is the percentage likelihood or probability that upon expiration, the option will expire in the money, which means if we take no action, those shares will in fact be put to us. It's stated differently that the option will expire with an intrinsic value component to it. So if the price of the stock moves below the strike price, it will be then in the money and therefore most likely be exercised if we take no action. So delta is a close approximation of probability of exercise. And that's how we're going to define it for this particular strategy. Now take a look at this price chart for Etsy, a stock that we identified months and months ago before making this video. And one of the reasons was, well, first of all, it was extremely sound fundamentally. And the price chart that you're looking at here shows that a very bullish price chart. Number 1 is the moving averages. You could see the blue line, the shorter term 20-day exponential moving averages above the longer term 100-day exponential moving average. They're trending up. And the price bars are at or above, on the right side of the screenshot, the 20-day EMA or blue line. So that's bullish. The MACD histogram, or those blue bars, are above zero. That's a momentum and trend identifying indicator, also bullish. Number 3 is the stochastic oscillator, has been ascending of late and above the 80th percentile, which, yes, it's overbought, but it bounced off the 80 and moved up again right at the end. So we have a bullish stochastic oscillator, another momentum indicator. And 4, you can see volume is still holding up. So overall, the mosaic paints a very bullish picture for Etsy, in addition to the very strong fundamentals that the company had at the end of 2020 leading into 2021. So here's an option chain taken again from that CBOE site. And you can see here that with Etsy trading at 169, we're going to only look at deep out of the money put strikes, which is much lower than current market value, in this case 150.250. Now we also want to make sure the delta is 10 or less. In this case, the strike price of 152.50 had a delta of 8, meaning an 8% probability of exercise. 92% probability it will not be exercised. How much premium do we generate? Well, we turn to the bid column, 44 cents. Now we have to make sure that fits into our initial time value return goal range, which is an annualized return of 10 to 20%. But I just wanted to show you how you look at the option chain to determine which strike price. Now let's break this down. And we're going to soon have a look right into my broker portfolio to show you some real life trades I made. So the 152 strike had a delta of 8, which meets our criteria of 10 or less. The bid premium I showed you was 44 cents. How much cash is going to be required? Remember the formula. Put strike minus premium. That comes to 152.06. The return is 44 divided by that amount, or 0.29%. We annualize that out to 15.1%. That's a 92% probability of success. We still have to be prepared for exit strategies in case trades turn against us, but the initial structuring of this trade is an annualized return of 15% with a 92% probability of success. Okay, we're taking a look now into one of my broker accounts. Top to bottom, I sold puts on Apple, Etsy, and QQQ. Now, for those of you not familiar with the Qs, that's an exchange traded fund that consists of 100 of the largest non-financial companies that trade on the Nasdaq exchange. You know, Apple, Facebook, Google, Microsoft, the big boys. So for every 1 share of the Qs we own 100 shares of these large cap tech companies. It's a great ETF most of the time, not all the time, but most of the time. Now, I'm going to show you the breakdown in my broker account of each of these trades. And for Etsy, I'm going to show you some position management executions I made. I think you'll find pretty interesting. Okay, for Apple, I sold the 121 deep out of the money put for 24 cents. Etsy, I sold the 165 deep out of the money put for 38 cents. And the Qs, I sold the 300 deep out of the money put for 52 cents. Let's break down the math. First, Apple. The 121 strike had a delta of 8, so 92% probability of success. Now, by the way, if it is assigned to us, that doesn't mean we've lost money on the trade. It just means that we now own the shares and we have to do something else with them. We'll get into that in a moment. But when I say 92% probability of success, I mean 92% probability that the option will not be exercised based on the delta of 8. Now, the minimum bid, the premium I got was 24 cents. How much do we put in? The put strike 121 less the premium. That comes to 120.76 per share. We take the 24 divided by that amount, comes to 0.2% per week, and annualizes to 10.3% within our 10 to 20% range. Okay, now buckle your seatbelts for Etsy, folks, because I did some nice position management trading with this security. And this is all during the course of 1 week into the Monday of the following week. Here's how I initiated my trade on Monday. I sold the deep out of the money 165 strike that had a delta of 9. So probability of success of non-exercise, 91%. We had a bid premium of 38. Cash required is 164.62. And that came to a 0.28% 1 week return, 14.7% annualized. Now remember that 14.7. That was how we initially structured our trade. Now look at what happened here, folks. Whoa, all of a sudden, Etsy took off for the moon. What happened? Well, it was double-barreled action. One day, Motley Fool came out and named Etsy as one of the best stocks for 2021. And the stock started to go higher. The very next day, Investors Business Daily came out with an article almost exactly the same, naming Etsy as one of the best stocks to buy for 2021. So the price of the stock started heading to the moon. All in that 1 week where I had sold the 165 deep out of the money put. Well, what happens when the price of the stock goes higher? Remember, the delta is negative for puts. It goes lower. And I was able to buy back that put that I sold initially for 38 for 10 cents and sold a higher strike, the 187.50 put, for 48 cents, still keeping that delta of 10 or less in mind, right? That's important because we want to keep the probability of exercise low. So in that same week, I spent 10 cents per share and generated 48 cents. So where does that leave us? Well, remember now, we generated 38. We had a debit of 10. We generated 48. Now we have a net credit of 76 cents. Excuse me. Okay. Now our cost basis goes up, doesn't it? Because we sold the 187.50 put. So our cost basis has now gone up to 187.02. Taking that 76 net premium into consideration, that means that our return is 0.41% for the week. That annualizes out to 21.1. So we went from 14.7 with this particular exit strategy up to 21.1. Was I done? Not yet. Same week, the price of the stock kept going up. And I was able to buy back the 187.50 strike for a penny. This, folks, is a screenshot of the trades that I made. 2 contracts bought back for a penny. That was a big sport. I spent $2. Now, I was able to generate 23 cents selling the 205 put, retaining my delta of 10 or less. And so where do I stand now? 38 cents to start. I spent 10 cents. I generated 48. I spent a penny. I generated 23. We ended up with a net credit of 98 cents. Now my cost basis went up because I sold the 205 strike. So it went up to 204.77. That brought my annualized return up to 25. So we went from 14.7 to 21.1 to 25. Now, here was the part that I was thinking about. When the stock price goes up so much, so fast in a short period of time, there's always the chance of profit taking. So even though the delta was still 10 or less, I knew that there was a chance that the price of the stock on Friday, remember, this is all from Monday to Friday, could dip below the 205. I knew that was possible. I said to myself, if it does, heck, I wouldn't mind owning Etsy at 205. I wouldn't mind it at all. What would I do? Maybe just keep 200 shares, or maybe keep 100 shares and write a covered call on the other 100 shares. Or if the price of Etsy bounced back up on Monday, maybe what I'll do is just sell the shares at a higher price. Let's see what happened. Well, on Friday, Etsy dropped just below 205. Now I could have bought back the put before 4 p.m. Eastern time on expiration Friday and not had the shares put to me. But I liked this stock at that time so much that I said, heck, I'm going to buy 200 shares of Etsy at 205. And I did. You could see on the screenshot there, I bought 200 shares at 205. But what happened on Monday? Well, Monday comes along and Etsy opens up much higher. And even though on Friday I bought the shares at 205, Monday morning I was able to sell them at 217.64. The profit I generated on the sale of those shares for the 200 shares was $2,529. How much work did I put into making that $2,529? Well, on Friday, I didn't do any work at all. I just let the shares be assigned to me. And on Monday, I checked the price of Etsy, and I went online and I went into my brokerage account and I just put in sell Etsy at market, and boom. So 3 minutes, 4 minutes, that's about it. And the shares were sold. And then I continued selling deep out of the money put options on Etsy on Monday. Now, remember, there was a third security I mentioned earlier when you were looking at the screenshot from my portfolio, and that was of the Qs. I sold the deep out of the money 300 put, which had a delta of 10, for a premium of 62 cents. The cash required was 299.38. And so that resulted in a 0.21% 1 week return, which annualized out to 10.8%. Again, meeting our target range of 10 to 20%. So the Apple and the Qs were not exercised. The Etsy was, and you saw what happened with that. So to kind of summarize the put aspect of the webinar, I'm here to tell you, and I've been doing this strategy since April of 2020, and I'm making this video in February of 2021, that in one of my portfolios, I have been getting significant annualized returns by using this ultra conservative put selling strategy where delta and weekly put options are incorporated into a low risk, high return strategy. Now, again, I'm saying low risk, folks. I'm not saying no risk. So you must be equipped with an exit strategy arsenal if a trade turns against you. You saw what I did with Etsy when it was in my favor and how I reacted when actually exercise was upon me. So you have to have all this figured out ahead of time before you enter your trades. Before I go, I want to tell you about a new package. I'm going to spend about 3 minutes telling you about a new package, new at the time that I'm creating this webinar. We call it the acronym BCI Package, for our best and most comprehensive investment package ever offered by BCI. And it consists of the annualized premium membership, 13 months. Annual in BCI terms is 13 months, which also includes 6 online video courses. I'll show you those in a second. 5 calculators and spreadsheets developed by myself and Barry Bergman. My 5 best-selling books in ebook format. And it's at a savings of 20%, $247 savings. The premium membership, there are too many perks to go through in a video like this, but there are 4 reports altogether. We do weekly stock and ETF reports. We do a monthly blue chip report, which I showed you in this webinar, and a quarterly dividend capture report. In addition to that, we have a large educational component available only to premium members, which includes over 200 educational videos, in addition to a bunch of files and other trading resources only available to our premium members. Now that we have online video courses, one for covered call writing, one for selling cash secured puts. Those are the big boys. We have another one specific for exit strategies for covered call writing. And then for covered call writing like or alternative strategies for portfolio overwriting, which I mentioned in this webinar, the collar strategy where we add protected puts to our covered call trades, and the poor man's covered call where instead of buying a stock, we buy a long-term deep in the money leaps option instead of a stock, so we can enter our trades at a lower cost. I like to believe, and I hope you agree with this, that we have the best resource for the poor man's covered call found anywhere out there, and that's one of the courses available. Now, we've developed multiple calculators and spreadsheets. The Elite Plus calculator is our newest and I feel best, which can be used for covered call writing and selling cash secured puts. Portfolio overwriting, a poor man's covered call, as well as the collar, not listed here. We have a trade planner for defining trade goals, primary and contingency exit plans, and also a stock repair calculator, which is really not for option trading, but if you have a stock that's gone down a lot in value and you want to bring your break even, up to a much higher price, you can do it without adding cash to your position using options. And the stock repair calculator will show you how to do that. Now, I'm humbled to say that I have the best-selling books on Amazon.com on both covered call writing and selling cash secured puts. And those are included in the package, the complete encyclopedia for covered call writing classic edition, a must and should be read before volume 2. Selling cash secured puts, also #1 on Amazon on put selling. And then covered call writing alternative strategies, which has portfolio overwriting, the collar strategy, and the poor man's covered call strategy. And finally, Stock Investing for Students, which is not options at all, but a financial literacy book. Things like dollar cost averaging, dividend reinvestment, difference between mutual funds and ETFs. A book that's been picked up by 4 universities here in the United States as a required part of their financial literacy programs. So our BCI package can be found on our website. There's a link I put on YouTube channel as well. If purchased individually, it comes to $12.44. The package is discounted 20% to $9.97. You can see on the screenshot where you can get it directly from our web pages or from the link that I provided on the YouTube channel. So there you have it, ladies and gentlemen. This webinar dedicated to both covered call writing and selling cash secured puts, specific for a low interest rate environment, specific for a volatile and unsettled economy. And there are a lot of ways to make money in the stock market. What I have presented to you in this webinar are 2 of those ways. So, ladies and gentlemen, I hope you enjoyed this webinar, and most importantly, I hope it puts cash in your pockets. As always, this is Alan Ellman, the Blue Collar Investor. Take care, everybody.